This conference will now be recorded.
This is now for chapter 1. Again, I'm gonna have this intro screen for most chapters just to help reiterate that this video will still be applicable up through at least early 2021. And for the 2019 tax season, this video will be using numbers for the 2018 tax season. However, you can always refer to my notes. My notes are always updated on a yearly basis every tax season. If there are any discrepancies, do follow those. If you are in the 2019 year, you will use this video to show how and explain the tax rules, but you will want to use my notes and the answers from my notes to check your work. With that said, there are two things that I wanted to touch on before we get into chapter 1 that I did not get to in my opening video that explained the class. The first one was how to do a notification setting. I said I would get back to that. The notifications are actually inside your account. So if you click on your picture, if you have a picture there, or just your account, and then simply go into the notification settings here, look through all of these items and see how do you want to be notified and when. You can pick these things. If you want to have a due date notification, that's usually a pretty good thing to have. I don't, but there's no need for me to have it. Whenever something happens in the class, if you want to, whenever I grade something, you can have a notification. I think this is a pretty neat thing to have access to. The second thing that I wanted to bring to your attention, so now I'm going to go into our class, is in module 1, let me backtrack here. At the end of the semester, I ask students, and you will get this opportunity as well, 7 questions on what they liked best, least, and what was how to help other students succeed. I would highly recommend go through this. There's a couple pages of some notes, and some of the students copy and pasted the actual question as well as their answers. Some of them just put the answers, but you can come back and look. So this first student did post the question. So you can see what the question was that I asked, and then their responses. And I think these will really help you kind of get a better idea and have a head start on how to do well in this type of a class, kind of a tough class and one that's online. All right, with that said, let's get into our chapter 1 material. So what you'll want to have is you'll want to have your book accessible, because we will be using some of the book for, while we do a couple of problems, and you'll need the tax information at the back of the book, the tax tables. If you don't have the book, you can look online and Google the federal income tax rate schedules. And when we get to that point, you will definitely need to pause the video and do that. This first part, you can read through and get most of this information. I'm not going to always hit everything. The first thing that I did want to mention here is the IRS does not write the tax rules. They simply are the enforcer, and they kind of take Congress's wording on the law, what Congress says the tax law should be, and then implements it into what can be used on a tax return or how they can enforce it. So Congress makes the general broad umbrella rule, and then the IRS will drill down and tweak that to make it understandable, and so that to close any loopholes that may exist. So Congress makes the laws, the IRS simply interprets it and then enforces it. The Internal Revenue Code, this is the primary piece that you'll always want to go back to if there's ever a question in a house on how something should be taxed or not. If it's unclear, the Internal Revenue Code is your primary source. Okay, so taxes, it's more than just funding the government, as we'll see, just through the different credits that they give or the penalties that they assess if you do something that they don't like or they think is detrimental to you. So it's more than it's encouraging you or discouraging you from certain activities. For example, this economic policy, they're going to give certain benefits if you do something. So if you buy new equipment and you're a business, you get a bigger write-off. You get less tax because you have less income, because they're allowing you to write off a lot more of that asset than just a normal depreciation would. So that would be considered an economic policy type tax, where it encourages you to do something. A social policy is giving you credit for going back to school, giving you money back, allowing you to take a deduction. On the other hand, states a lot of times will tax you higher on things that aren't in your best interest, like smoking cigarettes. State taxes are very high on cigarettes. They're trying to discourage, especially younger people who are wanting or maybe looking to start, to discourage them due to the high price. Another example of a discouragement would be taking money out of your retirement account early. You're going to be not only taxed but penalized on an early withdrawal. Government doesn't want you to take the money out early. They want you to have the money when you retire. The tax rate schedules, the structures here, there's 3 different ways that taxes can be assessed: progressive and the proportional or the regressive. You're most familiar with the first 2, and maybe the first one as the most. When you think of federal taxes, this is the type progressive, meaning the more you make, the more the tax rate increases. So if you make $25,000, you're going to be in the lower tax bracket. Whereas if you make $100,000, you're going to be in the higher tax brackets. And then if you make over, say, $500,000, you're going to be more up here in the highest tax bracket. So you're going to be taxed more and more the more money you make. That's a progressive tax, and that's what a lot of people either really like or really don't like. If you don't make a lot of money, you're in the lower to middle class, then you kind of like the progressive. If you're the middle upper or the upper class, then you don't like it. You're paying more money than maybe somebody else. You can see the differences. This is the brand new tax brackets that came out with the Trump administration, the job acts, the Tax Cuts and Job Acts, recent that was just overhauled. A lot of the items that you'll see, the differences between the 2018 moving forward and then 2017 going back, the tax rates are a little different. You can see the top tax rate did go down slightly. Even the lower middle class share 12% compared to 15%. So overall, the tax rates did go down with the new tax overhaul. The flat tax or the proportional tax means everybody pays the same rate, no matter what your income level is. And by far, the most common one that you will come across is our sales tax. In Indiana, no matter how much you make, whenever you buy something, excluding a few items like food, you will pay 7% sales tax. So therefore, if everybody pays the same tax, it is more burdensome on the lower income. If they have to pay the same amount as somebody who makes $1 million on that same, say they bought a used car, if they paid $5,000, they're going to pay 7%, which is going to hurt them more than somebody who makes $1 million and has to pay 7% on that same car. A regressive tax rate, there aren't a lot of these, but the most common one is Social Security, which basically says you're going to be taxed at a certain rate until you hit a certain income level. And for the year 2018, this number is $128,400. Once you hit this amount, if you do. Most of us will not, but some of your clients later on when you start working in tax, some of your clients definitely could make this kind of money. They will stop paying Social Security tax once they have hit $128,400 for that year in taxable income. So what I mean by a regressive tax means if you earn right at to the very top $128,400, the amount of tax you're going to pay is 6.2%, which means you're paying $79.60 in taxes for Social Security. The Social Security rate doesn't change. It's always going to be 6.2%. However, if you make $1 million, you still only pay taxes on the first $128,400 that you make. The other $871,000 or so that you earn on top of that 128, that doesn't get taxed. You're only going to pay tax on that first 128. Thus, if you take the $79.60 and divide it by $1 million, you're no longer paying essentially a 6.2% tax. Yes, you're paying 6.2% on the first 128, but overall, if you take $79.60 and divide it by $1 million, you're paying a lot less than 6.2% on every single dollar. Is what that means as a regressive. So here I'm showing you a couple examples to put it, so hopefully you can understand how the rate goes down. Even though it's the same rate, 6.2%, what you're paying on your entire earnings does essentially go down. So if you only make $55,000, I say only, when you compare that to $1 million, $55,000 at 6.2%, you didn't hit any caps, so you paid 6.2% on every dollar. Therefore, you owed $34.10. If you take $34.10 and divide it by how much you made, well, it comes out as it should to exactly 6.2%. Now, if you make $170,000, so you're a little bit over the cap, you're going to stop paying tax at $128,400. However, you're going to, on that $128,400, you're going to pay the full 6.2%. On the rest, on that the remaining 40-some thousand extra, you don't pay anything. So if you take the amount of tax you had to pay and divide it by 170,000, well, then you can see what your tax rate went to. It went down just a tiny bit. It went down to 4.68%. Not even a tiny bit, actually quite a big difference, almost 2%. So using this, the tax divided by how much you made, go ahead and try part C. Pause the video at this point, and I'm going to have you do this a lot as we go through the semester. You'll want to pause the video and actually work through each problem and see if you can get the same answers I do. Just watching me do it on the screen doesn't help as much as you actually putting pencil to paper and trying it yourself. So go ahead and pause and try to do part C, and in about 5 seconds, I'll start up again. Okay, with part C, hopefully you have taken the time to try this. The amount that you're actually going to pay is still the same as what part B was, the $79.60. But however, you're only going to take now $79.60 and divide it by the $1 million. When you do that, you're only paying tax on the entire million less than 1% because of that cap that you hit. So this is what's considered a regressive tax. When you're looking at your total income concerned, your tax rate actually goes down. Okay, at this point, if you do not have a book, you will want to go into Google or any search engine and look up the 2018 tax rate schedules, because we are going to be using that to determine your tax rate, your marginal tax rate, and your average tax rate. We're going to do some examples. So your marginal tax rate is what, if you make one more dollar, what is that next dollar going to be taxed at? So these up here that we looked at, these are your tax rates. Depending on how much you make and what filing status you're in, you're going to be in one of these 7 tax brackets. And it's good to know what tax bracket you're in. How much of my earnings are taxed if I make $1 more? And when I say $1 more, that doesn't mean, let me give you an example. If you make, say, $100,000, not everything is going to be taxed up here in these 20% areas. You're going to be taxed continually going up. So you're going to be taxed at 10% for the first so much, depending on your marital status. Then you're going to be taxed at 12% for the next amount of money that you made. So only the top dollars, those last however much it might be, are actually taxed at this higher rate. And I'll try to explain that better as we go through some examples. So at this point, what I'd like you to do is, in your book, or if you don't have the book, looking at in the Google, what I would have told you to find is in the Appendix F, the 2018 federal, this is what you would want to look up in Google, 2018 federal tax rate schedules. 2018 federal tax rate schedules. And this is going to list determining on what your filing status is, where your bracket is. Okay, so if we just take a quick look at the single, you're going to be taxed at, if you make, and notice there it says if taxable income is over but not over, if you make less than 95.25, you're in the 10% tax bracket. So not a lot of people are going to fall into that, but the key word there is taxable income. So more people are going to fall into that than what you might imagine, because taxable income is after your deductions, especially your standard deduction, which really is going to lower your income. So even though you may make $25,000 this year, after your standard deduction, that would drop significantly, and you may just barely be in the 10% or just into the next bracket there at 12%. So you can see the 12% bracket goes from 95.25 up to those with taxable income of 38,700. So that's a pretty big jump there. That your marginal tax rate in that case would be 12%. Now that doesn't mean that your entire income is taxed at 12%. Only the amounts from 95.25 to 38.7 is taxed at that. The first few dollars that you made that year, up to 95.25, were only taxed at 10%. So your taxable income, as I had mentioned, is your gross income less your standard deduction in very simple terms. Now, if we did go back to that tax rate schedule real quick, take a look at the difference between single and then the next one down, married filing joint. Notice how when I had said you can't just say if you make under 10,000 you're in the 10% bracket, because with married it's actually double that. If you make up to 19,050, you're still in the 10% bracket. So they're trying to not produce a what's called a marriage tax penalty, which I'll explain more as the semester goes on. There are certain times by being married you don't get as good of a benefit as if you were single. So if you made 50,000 in taxable income as a married person, you're in the 12% tax bracket, but as a single person, you're in the now 22% marginal tax bracket. Now, the only difference between marginal and average tax rate, the average tax rate says, what are you paying on if you were just to pay the same amount for every single dollar you earn? Instead of paying 10% if you're single up to 95.25 and then 12% on the next 38.7, how much are you paying altogether in just one amount? That's what we'll also figure out. It kind of gives you a better idea of how much tax you're paying percentage-wise. So as I said, income is taxed in gradual steps, not all of it at one specific rate. Okay, we're going to do the long way and the short way on how to figure up A, how much tax do you, what bracket are you in, A, and then how much tax do you owe compared to how much did you earn, so we can get an average tax rate. So with Bill in my example here is single and earns $99,000, and the key word here is taxable income. If he has $99,000 in taxable income and he's single, let's look at the book. And we go down to the fourth row where it says 82.5, but not over 157.5. Keep scrolling over to the right, and whatever percentage you see, that is the marginal rate. If he makes one more dollar, he's going to pay 24% of tax on that dollar. The average rate. So he's not paying 24% on everything. Let's figure out what he's actually paying on everything if we were just to do it all at once. The average rate, using our tax schedules, and this is also, we're going to do it the long method, and then we'll look at the shorter method as well in just a second. But we're going to use these same tables, the same federal tax rate schedules there in Appendix F. This is how you would figure out how much tax does he actually owe if he makes $99,000 in taxable income and he's single. So we're going to see how this is calculated. So with the $99,000, go back to the Appendix F, and in that fourth row, go all the way to the right. And what you always want to do is take your taxable income less whatever number that is. So the 82,500. That's how much, so that difference there of 16,500, that's how much he's only taxed at that high percentage at 24%. So he has to pay tax of $39.60. Then we have to add in all the prior tax up to the 82.5 to get his full tax. So if we go back to the Appendix F and we took it by 24%, that 16,500, and then it says add or plus 14,089.50. So in total, when we add those two together, he ends up owing $18,049.50. That's how much he would have to pay if he had no other credits or nothing, no other deductions for it to come along. So to find his average rate, then take the 18,000, how much tax he owes, and divide it by his taxable income. So even though his marginal rate is 24%, really on every single dollar that he makes, he's only paying 18.23%. We're going to try a couple of these as an example here in just a few minutes to make sure we've got this. You may want to go back and review that part. Make sure you have that down. That's going to be important. This is the actual tax tables that we're going to be looking at next. I'm going to pull these up. So if you do not have the book, you can go to this. Now, as of early 2019, this has still not even been officially updated yet, still in draft form, but for most of you looking at this, it will not have this front page. It will just come up as this, the 1040. And then here are the tax tables. And this is the quick way of finding how much tax you owe instead of doing that longer method. However, these tax tables are only good if you go to the very bottom. These tax tables are only applicable up through if you make $100,000. Now, this actually has more than just the federal. Here, you can see it goes up to 99,999. If you make over 100,000, you have to use the long version. And the long version, they actually have this for you. And it's kind of similar to what we just went through. If you don't have the book, you will want to use this. For me, it's on page 16, where it says 2018 Tax Computation Worksheet. So this is going to help you determine, but notice it's only applicable if you make at least 100,000. So it's not the best because it doesn't allow you to check all of the amounts, but it's definitely a good tool to have in case you have a situation, and you will in the tax problems, of somebody having taxable income over 100,000. You don't have to have the book at this point to still calculate the answer. Okay, I'm going to go ahead and use these on the screen so you can see and follow along. But let's look at that last example that we just had of 99,000 with a person that's single. So the words here is, if line 10 of your 1040, that's your taxable income, is at least 99 but less than 99,050. So if you had 99,050, you could not use this top row. You would have to go to the next row. We're at 99,000 even. Go over to single. Here's the amount, 18,056. Now let's compare that to what we just figured. 18,056, we figured 18,049. Very, very close. And the only reason there's a difference is because these tax tables assume you're right in the middle at $99,025. So that's why there's an extra tiny bit of tax if you use the tax tables than if you use the long method and got the actual answer. There's about a $7 difference, $6.50 or so difference. And that's what I had figured up here in our notes, and the reasoning why it's a little bit different. Okay, now I want you to take the next couple minutes, pause the video, and answer these two questions for example A. Okay, for example A, I had the individual making over 100,000, so you had to use the long method. You couldn't just use the short method to get how much tax they owed here when we get to the average rate. So Bob and Mary's tax return, if they file a joint return, so married filing joint. Again, this probably would help if you had the book, but you didn't have to. 112,000, if you come down here to married filing joint, and they're in between 100 and 165, here's their tax rate, 22%. And you could have gotten that from our book as well. If they have 112,000, they're in between, they're in that third row between 77.4 and 165 even. They are, if you keep scrolling over, in the 22% bracket, just like what we have here. So that was our answer one, the marginal rate. That was pretty easy to find once you know what you're doing. So the marginal rate was 22%. Now the tax, how much tax do they owe? I probably should have this as my secondary item, because we really don't need, for the marginal rate, we don't need to know what the tax owed is, but we do for the average rate. I got to know, to find the average rate, how much tax am I paying compared to what my taxable income is. So using the long method, and I'm using the method from the book now, not from this screen down here from the IRS website. So I go to the married filing joint in Appendix F, take my taxable income minus the 77.4. Let me put that back up. Whoop. This page here. Minus 77.4. 35,000 is taxed at that top rate for them of 22%. So everything else is taxed at a lower rate. So when you take 35,000 at 22%, you get 77.11. And then when we look at the book, we scroll over for married filing joint, and it says after you tax by 22%, add in 89.07. When you add these two together, the total tax that this couple will pay is 16,618. Now all you got to do is take 16,618 and divide it by their taxable income to figure out what their average rate is. So their average rate is lower, and it almost always will be lower than the marginal rate. The only time it won't be is if they're both at 10, if they make very little income. So every dollar they make is taxed at 14.9%. The next dollar that they make would be taxed at this higher rate, though, at 22%, until they get to the next tax bracket at $165,000. Okay, now to give you kind of an idea of how the 1040 is laid out, and we're going to go through the 1040 here in a few minutes. Actually, we'll go through it here. We'll go through it here in just a couple minutes. But to kind of give you an idea, when you start out, your income items are always at the top. And we're going to hit these particularly when we get to chapter 3. Next is in one of the new schedules for the 1040 is any deductions that you may have for adjusted gross income. You're gonna find that we use adjusted gross income quite a bit in this class. That's a pretty important number. We talk all about these deductions in chapter 4. When you take the income minus your deductions, you get your adjusted gross income. Then you take out your standard deduction, which we're going to hit really hard this week and next week. Or you get to deduct your itemized deductions, which are found, and we're going to go through that in chapter 5. When you take your income, that's what I had said earlier. Basically, your taxable income is your gross income minus your standard deduction. That's most of the time. That's how you get your taxable income. Then we do the tax schedules like we just did. We find how much do you owe. That's our gross tax liability. Once we've done that, then do we have any other taxes that we have to pay? Or do we get any additional credits that we can take off of our taxes? So this could be something like earned income credit or the child tax credit. Or these extra tax and penalties may be a penalty for taking money out of your IRA or having the health care with not having insurance type penalty. Finally, you take your how much do you owe minus any credits you received, adding back any taxes, and then finally minusing any payments you already made, which would be on your box 2 of your W-2 when you get taxes taken out. When you've done all that math, you're basically going to come up with, do you have money that you still owe, or are you due a refund? Have you paid in more than what your liability was? All right. Beginning with the 2018 tax year. Remember, taxes are always done in a year back. So even though I'm making this video in the spring of 2019, we will just be getting started with 2018 taxes. So we go back and we figure out how much money did you make during the 2018 tax year. With this new tax law that just came into effect, there is now only one 1040 instead of 3 different types of 1040s. The 3 different ones, there was nothing bad about that. I think maybe a W-2 and some unemployment income, and that was it. No dependents, you're single or married filing joint. You could have filed this 1040EZ. It's just 1 page, very basic form. This one was kind of the middle of the road. You didn't have a whole lot of complexities, but you still had some dependents, maybe some education credits. This is if you had your own business, you had rental income, so some of the more complex things, the 1040. Now there's just one 1040, and then you're going to add some of these more complex schedules if needed. So the schedules 1 through 6, actually really only 1 through 5. The 6th one is just for some signatures. you only add those if you have the more complex items. All right. So what I would like for you to do now at this point is you can turn in the book or follow along with me as I go through the one that I'm going to pull up. A real good 1040 to look at is usually in the front part of the chapter 2. So if you turn to page 2-3, even though we're not in chapter 2 yet, this is a good 1040 to use as a visualization. Pause the video if you need to, pull that up. I'm going to pull up my 1040. So the 1040 here, you've put in your filing status way up here at the very top. It'd be very easy to miss. I would like him to see it, make this maybe a little bigger. You and your spouse name, if applicable, your address, and then over here, you need to check this box if you simply had health care for a whole year or you were exempt. If you don't check this box, then they're going to be expecting you to show penalty. And then finally listing your dependents over here, if you have any. And then if they qualify for which of these type of credits, usually it'll be one or the other. The child tax credit is the more beneficial. For this week, we're going to really only look at the 1040, the real basic, without any of the schedules, and then we're going to get into the schedules as we go through the semester. So as we look through the real basic 1040, and you can see there's a huge gap here. These are really all one page. For whatever reason, it's broken into two right now, but it's really going to be one just page. And you can see the basic 1040 is only lines 1 through 23. That's it. Then you're going to add in your additional schedules as needed for more complex items. In comparison, if you were doing this last year in the 2017, the 1040 went through at least line 70, 73 or so. So they've taken out a lot of it to say, okay, if you have a real simple return, you should be able to put everything in these boxes and still compute your tax liability, kind of like a 1040EZ, but a little bit more complex. So as you can see here are the 5, what I'm going to consider the 5 basic, or what the IRS has also considered, the 5 basic income items that you can have and still not have to have any of the complex schedules, even though they're not really complex, just the extra schedules. So your W-2s, any interest that you have earned, like maybe from a bank or bonds that you have, so tax exempt or taxable. Any dividends that you have earned through your stock investments, retirement money that's come in, and then finally Social Security that you have. So what you're going to add up all of these, all 5 of those lines, and then as we get into chapter 3, we're going to look at schedule 1, and then any of those additional income items. We're going to put everything here in line 6 of your total income. Then in line 7, you're going to subtract any of those deductions. You're going to subtract any deductions that I had talked about earlier when we were going through how the 1040 is laid out. So the gross income less your deductions, those are also on schedule 1. So we'll talk about those when we get to chapter 4. You're going to subtract those from line 6, and you're going to your new amount, and this would be your adjusted gross income. And then we're going to subtract either our standard deduction or itemized deductions. We'll get into that in a little bit, just a few more minutes. We'll look at the standard deductions. We're not going to worry about line 9 for the first half of the semester. After we subtracted all that, now we get our taxable income. Remember that it had read that in our tax schedules. It said line 10 of the 1040. This is the number we would look up in the tax schedules to see how much tax do we owe. And once we've looked it up, it goes right here on line A. Then we can start deducting some credits. The child tax credit here, and then any of the other credits from Schedule 3. So those other credits could be educational credits, your dependent care credit, like if you have to have babysitters for you to go to work. Those are a few of the credits you could have. We talked about other taxes like penalties on your IRA or health care. If you have any of those, you do Schedule 4. Finally, you're subtracting out how much you've already paid in with your W-2, showing on your W-2 box 2. And then your last piece here is earned income credit. Any items you get to take that are called refundable credits, and we're going to look at those in detail when we get to Chapter 9, still before the midterm. And then any few extra taxes that may be applicable here on Schedule 5. We're not gonna have any of that for our class. So this kind of gives you a real basic look at the 1040 and what we're going to be going through this year. Okay, back to my notes. Okay, so when we walk through the 1040, this is just kind of a word form of what I have just had said, so it's good to kind of go back through and see it for yourself. Your AGI, your standard deductions. For this chapter, these are the two amounts that I will want you to know. The standard deduction for somebody single is $12,000, and then it's double that for married filing joint to avoid the marriage tax penalty. Line 10, line 11, line 10, the tax tables. Line 12, those very common credits that a lot of people will have. Let's keep going. All right, let's actually try to do a tax return. Just a basic one. Nothing real complicated with this one. I tell you that Joe shows $43,000 on his W-2 in box 1. That's how much his gross income is. And $3,500 for box 2. So that's how much he has withheld from his taxes. He has a little bit of interest income. And then I give you some other information. He has electric bills of $4,600, grocery receipts totaling $3,345. Joe is single, and I want you to be able to tell me these following amounts. So there's 6 of them. So go ahead and pause the video and answer those, and then I'm going to go through and explain how I got the answers and see how you did. All right, let's go through these answers. First thing to note is we need to put in the types of income. Well, we have 2 different types of income. We have his W-2 income and his interest income. So let's go through these in order. Joe's AGI, when you put in line 1, you would have put in $43,000 in line 1 of the 1040. $43,000, and then taxable interest, we would have put in the interest amount here. We didn't have any other types of income, so when you add those 2 together, that's how I got line 7, the AGI. Notice he doesn't, this is just extra information. We'll get into more of this as we go through the semester, but I wanted to show you and give you an example that just because it's presented in a tax problem or somebody brings it to you in an actual real case scenario, doesn't always mean it's tax related. Electric bills, you don't get a deduction for personal electric bills, nor do you get a deduction for your grocery receipts. There's a lot of personal things that you don't get deductions for. That's what the standard deduction is out there to do. So our line 7 was $46,500 for the standard deduction, because that would come next. With this person being single, they get to take off $12,000. They're not going to be taxed on that $12,000. So that brings us to our taxable income. This is what we would actually look up in the back of the book in those tax schedules, or from this sheet here, we would You would go and find this amount, and we'll do that in a second. Let's get what it is again. $33,500 for somebody who's single. So let's go to $33,500. You can do this in the book or on this IRS site. $33,500 for somebody single. So they are at least $33,500, but not over $33,550. Single says they owe $38,33 in tax liability. $38,33. Now, if you're in a future tax year, if you're in the year of 2019 or 2020, your amount will be slightly different. Use my notes. Use the answer key from my notes to see what your tax liability should be. It'll be close to this, but not exact. Finally, then, if we owe $38,33 and we have no other credits to take, nothing else that's going on, we look to see how much did I have taken out of my paycheck. I had $3,500. I really needed to have $38,33 taken out. So the difference is that I actually owe money. I owe this difference of $333 that I'm going to have to pay with my tax return. So this is a real simple little example, and I'll have something very similar to this in the homework for you to do, just to begin to get you familiar with the 1040. Okay, just a couple more things that I'm going to cover, and then the rest of it you can read through on your own. Does everyone who earns income have to file? And the answer is no. The key thing that you'll want to look through is on page 1-13, and we're going to hit this more next week as well. But this just kind of gives you an idea. If you look at page 1-13 in the book, it gives you a nice table and tells you if you have household income, if your income is below this dollar amount, your total income now, not just your taxable, but total income. If you are single and under 65, you don't have to file if you make less than $12,000. However, you most likely should want to file because there's going to be taxes taken out of your check, and if you file, you'll get that money back. Notice that $12,000, that number should be, you should have seen that recently. Basically, for every filing status there, single and under 65, the $12,000, that's your standard deduction. So if you make less than the standard deduction, you don't have to file. Look at married filing joint, and both are under 65. The 24, the other number that I wanted you to know for this chapter. Again, you don't have to file, but typically it is advisable to file to get back some of that money. All right, the last thing that I really wanted to cover, now there's a few more, but this is the last big item. The healthcare coverage. 2018 is the last year, this is the last taxable year, I should say, the last taxable year that you still had to have insurance or you're going to be penalized. Now, this could change. There could be new, and I expect there will be some changes in the healthcare reform. As of right now, though, when we get to 2019, you don't have to have insurance, and you won't be penalized. But as of this year, for 2018, you are, so that's why I'm covering it. So this will be the biggest change as we go forward from 2018 to 2019, if it stays as it is, without any new updates from Congress. Penalty, if you don't have insurance, notice this key word here, it's the greater of, not the lesser of, it's the greater of. 2.5% of your household income. So if you made $1 million, 2.5% is quite a bit of money. Or if you don't make very much money, $695 per adult is quite a bit of money. Is a pretty big penalty to have to pay for not having insurance, but still it's probably less than buying your own insurance if you're a healthy adult. Maybe that's a better deal. And then that's half of that for a kid. And then this max, if you were to add up 2 adults, 2 kids, you're going to get this $2,085. So they do max it at that point. So you don't have to pay if you have 6 kids. You don't have to pay that much for every single kid. And then this is if you didn't have it for the whole year, you figure out what this amount is. And then if you only didn't have it for a certain number of months, you take whatever that number is, the greater of, multiply it by 1/12, and then add up that number, the 1/12, 1 month for every month that you do not have insurance. So maybe you'll take it times 1/12 and then times that number by 5 for the 5 months you didn't have insurance. Now there are 3 common exceptions that I'm going to cover here. That reasons why you would not have to have insurance and not be penalized. If you have less than a 3-month gap of coverage, and that means if you had coverage February the 8th, and that's when you were fired or you quit your job, that counts as February coverage. So your first month would be March. So if you didn't have March, April, May, then you're going to start being penalized because that would be more than 3 months of coverage that you didn't have it. As long as you're less than 3 months of coverage, then you don't have to pay for those couple months that you didn't have any insurance. If you're below the filing threshold, so that goes back to page 1-13 in the book. If you make less than the standard deduction, you don't have to have insurance. It's going to be considered unaffordable for you. And then finally, if the cost of insurance for you is over 8% of your household income, then you are exempt from having to pay it because it would be too much of a burden. And that's a little bit more difficult to do, something we have to do more research on. It's not something I'm going to really hit on in this class. It's something I do more in my payroll class, and we actually do it when doing real tax returns. There are certain sites we can go to figure out how much cost the Obamacare would be for an individual at where they live, what their smoking status is, and their age. It'll tell how much you would owe in coverage, and we would compare that to 8% of the household income. And that's gross income. Okay, let's do some of these examples. I'll go through us with example C, and then I'll pause it, and we'll have you guys do D and E. See how well you've got this. So we're going to be using this penalty area and any exceptions potentially to figure out what the penalty is, if at all. All right, neither Tony D nor his wife, who are both under 65, had health insurance all year. Total household income was $33,000. What would the penalty be? Okay, they don't hit any of these that we know of. We can't really check number 3. So the first 2 we can check. They didn't have it all year, so that takes away number 1. They weren't below the filing threshold. The filing threshold was $24,000. If we look at page 1-13 for married filing joint, both under 65. So they do have a penalty. They're going to basically be one of these 2. So let's check it out. So the penalty, the greater of, and the one thing that I forgot to mention here, 2% of household income, and I didn't mention this important piece, 2% of household income that's over the threshold. And the threshold meaning the one on page 1-13. So the threshold, we get to take away that standard deduction amount. $33,000 minus the standard deduction amount says $9,000. Okay, that's how much we're going to tax at the 2.5%. So that says only $225, but we got to find the greater of. And the greater of is definitely going to be $695 per adult with a max of $2,000. Well, we don't hit that much, but $695 twice gives us $1,390. That's what the penalty would be for not having health insurance for this couple, unless they hit that tax insurance, the 8% of household income exemption. That would be their only saving. Okay, now with that, go through and complete example D and E, and then we'll talk through this. Go ahead and pause at this point. Okay, let's go through the answers for D and E. With example D, now we don't have insurance for some of the time. It says Tony D and his wife had insurance after neither had insurance after he lost his job April 11th. Household income will still use the same amount, $33,000. What would the penalty be? All right, so it's the same penalty to start out as C above. We can redo the calculations, but it'd be kind of just redundant. Take the 33,000 minus the 24. But what we want to do as our next step is, since it's not a full year penalty, we want to divide that 1390 that we got by 12 months to figure out what is that amount for every month that they don't have insurance. How much do they owe? And when I did it, I calculated it out to be $115.83 a month. If you take the 1390 divided by 12, 112. They didn't have insurance for 8 months. And I counted those out to be May, June, July, August, all the way through. You don't count April, the month that they had partial month, that counts. So 8 months that they didn't have insurance. So instead of paying the full 1390, they only have to pay $926.67 in the healthcare penalty. And then for Part E, they didn't have insurance for only a short amount of time. Therefore, they do qualify for the exemption, the short coverage gap exemption. No penalty needs to be reported on the return. All right, the rest of this you will definitely want to go through. There's no real reason for me to read through the rest of this to you. It's things that you need to know, but you can read through it yourself and to get some of the most important things. I will hit a few of these items here on Appendix B that I think are kind of important. It's scary to me that anyone can be considered a paid tax preparer. You can put up a business sign and just say, hey, I can prepare your taxes, pay me money and I'll do it. Well, fortunately, the IRS has kind of put a stop to that. They were overruled in the court system a little bit, as I'll show you here in a second. The first thing that the IRS did, and this was okay with the court system, is you have to have a P10 number, which is a practitioner's identification number, basically, a prepared tax identification number. It's kind of like having a social security number, and this is the way the IRS can keep track of who's preparing tax returns. So if they see an error come along, and lots of errors, and each of them has the same P10 number, they can go to that preparer and see what kind of business they're running and maybe inform them that they're doing things wrong. It could be just out of, they just don't know, but they may also find some fraud activities going on as well. So you have to have a P10 number to to collect and prepare the public's tax returns. The big part of having a P10 number, besides just having it, is to keep it active, because the IRS will audit it, is you have to have at least 15 annual hours of continuing education. And this is a big step forward. So not just anybody can prepare taxes on a paid basis. You have to have at least 15 hours. Somebody like myself as a CPA has to have way more than that. We have to have 40 hours of continuing education. But at least a tax preparer has to have 15. In the previous year, you had to pay at least $65 to keep your P10. However, the courts have shot that down since. So it's no longer that you have to pay money to keep your P10. It is free, but you still have to do the 15 hours. Okay. Circular 230, if there's ever a situation where you're unsure of how to act ethically, Circular 230 is a great resource to go to that gives some good advice on ethics and what you can and can't do as a paid preparer. So, and then here are just some of the items that I thought were kind of interesting. All right, with that, the last things that I want to do, and you can actually do these, I'll have you do these on your own, is I have listed, and I'll have these answers out in IVY Learn. I have some questions that you should go through, and I'll put these up here. So number 41, you should look at in the back of the book, or the back of the chapter. 44, 48. These are ones to practice and then check your work to see how you're doing. 50 and 53. If you can get these, then I'm pretty confident that you should be able to handle the homework and do fairly well. Remember to get me your, if you want your homework to be checked, get it to me by no later than Monday morning at 8 a.m. or more likely Sunday night. Get that to me way before that, and I'll get it back to you fast so you can stay ahead. That is the absolute best way. Get it to me midweek, and I will check your work and email it back to you so you can do very well on each week's homework. All right, with that, we will close off, and I will see you on week 2.